When we meet with couples, one of the key planning objectives we focus on is equalizing income. The reason is simple. In Canada's progressive tax system, the more uneven your income is as a household, the more tax you tend to pay. Ideally, this sort of planning starts early, with the higher income spouse covering expenses, maximizing TFSA contributions, and utilizing spousal RSPs, while the lower income spouse builds and preserves their own savings. Over time, this helps create better balance. However, even with good planning, many couples still retire with uneven income. While pension splitting can help in certain cases, not all sources of income qualify. This is where additional strategies become important, such as setting up a spousal loan. A spousal loan is a CRA-recognized strategy that allows a higher income spouse to lend money to a lower income spouse, so that investment income can be taxed in the lower income spouse's hands. Under normal circumstances, if you simply transfer money to your spouse to invest, the attribution rules apply and the income is taxed back in your hands. A properly structured spousal loan avoids this, allowing for legitimate income splitting. The structure is straightforward, but it must be executed properly. The higher income spouse lends funds at the CRA's prescribed interest rate, which is set quarterly and locked in at the time the loan is established. The lower income spouse invests those funds, and all income earned, whether interest, dividends, or capital gains, is taxed at their lower marginal tax rate. To ensure the strategy remains valid, a few key rules must be followed. The loan should be documented through a promissory note with clear terms. The interest rate must meet the prescribed rate at the time the loan is made. And most importantly, the interest must be paid each year by January 30th. If that deadline is missed, the attribution rules apply and the strategy breaks down. In practice, we structure these as interest-only demand loans and coordinate the setup carefully, including how accounts are titled and how funds are transferred. Where this strategy becomes especially valuable is in situations where there is a meaningful income imbalance, such as in single-income household with a large non-registered portfolio, a significant inheritance received by one spouse, or the sale of a business that creates a large lump sum of investable capital. Without proper planning, all investment income would be taxed in one set of hands, often at the highest marginal tax rate. With a properly structured spousal loan, that income can be shifted and taxed more efficiently over time. And because this is a long-term strategy, the tax savings continue to compound as the years go on. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.